Money Show.
Personal Finance with Warren Ingram.
Warren with us this evening on Personal Finance, brought to you by Satrix. Invest in global funds. Invest with Satrix. Warren Ingram. I don't know if the worst is behind us in terms of the economy. I don't know if the worst is behind us in terms of COVID-19. What I do know is we need to get our house in order. We need to get our personal finances in order. We need to make sure that we are fit for whatever comes next. Help me, doctor. Help me. Tell me what to do.
I'll do my best. I think it's right to say we were not through the worst of the economic troubles, but I think it's also right to say we're probably through the worst of lockdown. You know, if the country goes back into different stages of lockdown, it's extremely unlikely we go back to the worst in a tighter stage. So I think moving along and trying to kind of get ourselves going again, I think the one thing to tell people is it's actually time to say, okay, this is wherever we are now in terms of the country, COVID, the world, the economy, stock markets, etc. I mean, this is the starting point. I think we kind of froze off, it feels to me, for quite some time. You know, we just went from one day to the next, and initially in a survival mode, and then I guess in a bit of a state of shock, and then I guess a lot of people in a state of anger and anxiety, etc. And the problem with all of those emotions is it's natural to feel them, and it's good to feel them, I guess, because it's moving you to a state of acceptance. But I think that's the point now. It's time to say, we're here now, and whether we like it or not, this is where we are. And we need to start taking some action for ourselves as investors and start to move ourselves forward as much as we possibly can. And I think the starting point is just to take stock financially of where you are. You know, if you did lose your job, you know, what are you doing about that? If you were lucky enough to keep your job, you know, what's going on, and if your income was compromised a bit, it's time to just get an idea of where you are, and then again reset for the new sets of goals that you need to set for yourselves. It's really bad from a monetary point of view to just try and live from day to day. If you are generating an income, or you have debts and you need to do something about them.
The debt issue is such an important one, though, Warren. I mean, debt is the big ogre in the room, and interest rates are so wonderfully low at the moment, lowest in 50 years, lowest in most people who are listening tonight's lifetimes. You've got to be taking advantage, I think, of these low interest rates to get yourself back on track.
I agree, and I think that, you know, the bulk of salary earners in South Africa, you know, sit with some level of debt, and so that must be the starting point for anybody looking at their financial position. And I think, you know, don't ignore it now. The problem with debt is that it starts to compound against you day after day. And unfortunately, you know, it starts off like a baby elephant, but before you know it, it's a massive elephant, and it'll eventually trample you. So the starting point is to understand what your debts are, and then try and have a look at what costs you the highest rate of interest. You know, a lot of the time when we look at our debts, we would say, you know, I've got a credit card and it costs me, you know, 5,000 Rand a month to service my credit card, but I've got a home loan and that costs me, you know, 100,000, you know, to service. So I'm going to focus on my home loan. But what you actually need to do is to understand how much interest are you being charged on your credit card. Because if your interest on your credit card is 25% a year, which is what a lot of them have been in the past, and your home loan is costing you, let's say, 9% a year, then actually the answer is you need to go and look at your most expensive debt first and start to sort that debt out as quickly as you possibly can. As you say, the interest rates are low, you know, certainly the lowest in my lifetime. And you know, if we get to keep these low interest rates for the next year or two or three, then now's the time to try and get those debts down as fast as possible.
But while I'm getting my debt down, you then kept on demanding, and I was saying, oh no, and don't forget about your emergency fund, because for many people who had been listening to you and had been obeying and did have the emergency fund, they would have been flippin' grateful that they did. But for many people who did have an emergency fund and ran into trouble, that emergency fund may be very, very severely depleted. I mean, it's been 7 months almost to the day since the lockdown started. And for many people, that's 3, 4, 5, 6 months more than they had money in the bank.
Absolutely, and so it's a great point. You've got to get your emergency fund going. I think what I would say is at the early stages, just try and get rid of your short-term debts first. So get rid of your credit cards, your personal loans, your overdrafts. If you manage to get that right, you can continue to pay off your mortgage at a normal rate until you've got your emergency fund going. And for most people, just to understand, if you've got a sort of a reasonably stable income, that's about 3 months worth of your expenses. If your income is up and down, if you're a contract worker or something, then you probably need to have about 6 months worth of expenses in your emergency fund just to be safe. And then keep going on sorting out the debt.
Warren, yeah, I mean, so many people, I think, are so hard hit. Because the expenses have, they would have done what they can to reduce their expenses, and they may have, they wouldn't have had the holidays, they wouldn't have had the travel, they haven't had to spend on the clothes and things. But for many people, their finances are in really rough shape. And the next thing you're going to tell me is, while I'm paying off my debts that I've drummed up during lockdown because I didn't have enough of emergency fund, not only must I get rid of these debts, rebuild my emergency fund, but I need to be investing possibly even more than I ever have before, because actually this year is pretty much a write-off in terms of investments. So let's do that too. Why not just get us to multitask, why don't you, while tap dancing on a bloody tripwire with hand grenades on either side? Throw it all at us. Go on.
This is the tough love show where we show our love by giving you the things you need to hear, not the things you want to hear. Nice. So I think it's just important. While we're coming out of this state of shock, and it's you have to look at your investments, understand what's happened to them. If certain things have gone down a heck of a lot, just understand why they've gone down. So for example, is it just part of a normal market cycle? Will they recover? If it is, they don't sell them and don't change them. But if something's taken a permanent knock and it's unlikely to recover, then you need to review that and say to yourself, well, the fact that I've taken a huge loss on this, don't just sit on it and hope that it'll get better. If it's unlikely that it is going to get better, get rid of it, sell it. The only benefit of selling an investment that's lost money is that you get to offset that loss against future capital gains tax, which is putting lipstick on the bulldog, and then look at your investments and say, well, what about the future? Where do I put my money so that I get the best chance of growth again? We're all extremely worried about the South African economy. So potentially you want to be in the JSE because a lot of those shares are not necessarily invested in the South African economy. But you need to get your local and your overseas balance right. But don't just leave things because they look bad. You have to look at them, review them, understand what they're doing, and then reset your investment goals as well as your debt goals and everything else.
Warren Ingram, if COVID-19 has taught us nothing, it is that we need to expect the unexpected, because for years the unexpected doesn't happen. We can kind of forecast the future, and then the unexpected does happen and it knocks us for six. In a moment, back with Warren as we talk about Andrew's question. I would like to know the best way to finance university fees, says Andrew. Pick up with that with Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So we got a letter, an old-fashioned letter in the post. No, it wasn't, because that would never have arrived. We got an electronic mail from Andrew. I don't have the money to pay the full fees for university up front, but essentially I have the following options. I could take out a student loan on behalf of my son and pay it off during the year. I have a home loan with 5 years to go. Unfortunately, with FNB, they don't allow you to access the equity in the last 7 years of your loan. So I effectively have to reapply for access to the equity. I could take out a normal loan and pay it off over the year. Are there any other options? Asks Andrew.
So I think it's this is another really common problem for a lot of parents and students, and so I think my starting point is just to talk about the other options. There is one which is a state institution, the National Student Financial Aid Scheme. So it's NAS, it's NSFAS, and that's their website, and it's definitely worth looking at. There are some caveats. If you've got a household income, it needs to be less than 350,000 rand a year or less in order for you to qualify on that. But certainly, if that is your position, then that's definitely a good option to look at. If that's not an option for you, then looking at your other options, to me, I think that the one to go for is definitely the student loan on behalf of your son. If it's something that you can pay off during the year, then I think that's a much better option, for example, than going through the costs of refinancing your home, because you actually have to pay lawyers' fees to get that home loan re-registered, and it's expensive. And particularly if you're in the last 7 years of your loan, it sounds to me then might also be reasonably close to retirement. You don't really want to put your home loan at risk, for want of a better word. So I think to me the student loan is the better option. A normal loan, not a bad idea, but the interest rates are important. So a lot of the time, the bank might give you a personal loan, and the personal loan might be quite expensive as an interest rate. And again, interest rates are important here. So don't go for something because they say it's convenient, but they charge you in the current environment, 11 or 13% a year. If a student loan can be offered at a bit of a better rate, then I think that's still a better option for me. But if you can get a personal loan or a normal loan at a decent rate somewhere close to prime, and you can pay that off yourself through the year, then by all means. But I also think, as a parent, teaching children about the value of money and understanding that, the student loan is for their benefit, it's not a bad thing to do. And even if you do pay it off for them, having the conversation, taking them through the experience of getting a student loan, because actually what happens is your son will be the person that's liable for the student loan, although you're going to sign surety. I actually don't think it's a bad deal at all. And we've spoken many times on the show to Julia over the years, the super saver, and that was one of the things that taught her financial discipline and budgeting was taking responsibility for her student loan and paying it off over her career. So Andrew, to me, kind of all my bets go for the National Student Financial Aid Scheme first, student loan second, normal loan third, and then your home loan if the other options don't apply.
And the last thing a parent wants to do, particularly if they can afford to make life easier for their child, because I think that's a natural instinct of parents, is the last thing they want is to have their child hamstrung by debt when they graduate, particularly in an environment where, jobs are not necessarily guaranteed, and where, if you're brilliant, you'll be fine and you'll start earning well and you'll pay it off in no time. But for the vast majority of people who go to university, it's going to be a huge burden to pay back that debt. And so, the idea then, and I come back to this in the same way as we talk about when people go into retirement, the idea of the side hustle, encouraging your child to be gainfully employed, doing something. Whether it is in their specific field of expertise or whether it's in traditional, I don't know if traditional student jobs exist anymore, but whether it be the shelf stacking or the beer pouring or whatever the case might be.
It's a brilliant entrepreneurial lesson for students as well. I spent many hours of my varsity career standing at intersections, handing out flyers for as part of a student job, and then driving stuff around for companies and serving drinks at functions. And so definitely, those jobs are around, and there's always the option of finding a good work. And I think for a student in that position, it starts to help you get your independence as well. And I think no student wants to feel like a burden on their family either. So definitely, it's a great conversation to have as a family. And if you can help if Andrew could help his son get going, that's great. But certainly, if I'm Andrew's son, I want to take control of my destiny as much as possible without compromising my university career. But at the same time, I think to understand that the more you can work while you're a student, that's experience that you're building up. And as employers are going to look at that and say, well, that's someone that's got chutzpah, that's someone that shows initiative, they understand already a bit about the business world, how to generate an income, the importance of pitching up and doing your job and being reliable and all of those things. So it is a real win for everybody involved, but just make sure that you don't compromise your university career at the same time. I think
frankly, many students are going to compromise their university careers themselves, regardless of whether they have a job or not. The job actually may be the saving grace, because if they're putting money away and saving, they've got less stress and less worry and fewer hangovers. And so from that perspective, perhaps a little bit more focused. But I'm hoping, Andrew, that helps because it's so important. I mean, just this idea, and it's something I hadn't ever considered actually in terms of in the traditional 20-year bond, that in the last part of that bond, and this is why everybody should be reading the terms and conditions of their bond documents, because they probably have ignored this fact that, I don't know if it's across all banks, it would make sense that it is, that at some point the bank says, no, you can't just keep dipping into this little pot of money as you have been through your life, because actually we do expect you to fulfill your contract by the end of this 20-year period. And no, you can't, it's no longer your piggy bank. You need to pay off the capital on this loan now.
Yeah, and you're right. It makes all the sense in the world that a bank would want you to end the term, having paid the bond off. So I agree with you. It wasn't something I actually had thought about, that it would be actually 7 years before the end of a loan. It's quite a long time, But certainly I can understand the principle. I think 7 years is a bit tough. To me, it should be somewhere around sort of 3 to 5. But I guess that could be unique to the bank or all banks, as you say.
Warren Ingram is a director at Galileo Capital. He is a personal financial advisor. He is a chartered financial planner. He is a former financial planner of the year, and he joins us on a Thursday night to give you the wisdom of his insights. You can email us, you can WhatsApp us, you can do whatever you like to get your messages to us, but it's really, really important that you get your questions to us, and we'll do our very best to get Warren to answer those questions for you. We'll get a word of the week in a moment. And if you've ever wondered what a living annuity is, but you've been too afraid to ask, we'll get that question to Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Warren's word of the week, phrase of the week, our question to Warren: what is a living annuity? Now, you may have a retirement annuity. You may have played Monopoly and it says the bank pays you an annuity. And then you look at a dictionary and the dictionary tells you that it's a fixed sum of money paid to someone each year, typically for the rest of their life. And then you go, okay, that's an annuity. I've got a retirement annuity. Monopoly talks about annuities, but what on earth is a living annuity, Warren?
I'm impressed with your definitions there. You're just throwing them out there. It's amazing.
I know, especially the Monopoly one.
So when we've got a company pension or a company provident fund or a retirement annuity, when we eventually get to the age of 55 or older, we need to actually retire those one day and start drawing an income from them. And we have two main options. So the first one, which is what you've spoken about, is a normal annuity, which pays us a monthly amount for our lifetime. It's also called a compulsory annuity or contractual annuity. The other option is that we can retire our retirement fund and put it into this thing called a living annuity. And what happens there is you take the bulk of the money and you put it into this investment vehicle that you can control to some extent. In other words, you can put it in with a unit trust company or an insurance company, and you have some discretion as to how the money gets invested. So you can decide how much goes into cash, into bonds, into property, and into shares, how much is in South Africa and how much is invested overseas. And then you can draw an income from that living annuity. And the law is quite strict on this. It says that you have to draw a minimum of 2.5% a year from the value of that annuity, up to a maximum of 17.5% a year. And so you have that choice, that it gets given to you once a year. So let's just say you retire on the end of June, so the 1st of July. Every year you'll be able to decide how much you draw from your living annuity. So it's a much more flexible investment than a normal annuity, because the second part of a living annuity is if you don't spend all the money through your lifetime as a retiree, and you decide to be quite careful and considered with that money, and you want to leave some behind, you can nominate beneficiaries on your living annuity, and that money will go to your beneficiaries. And the good part about that is that it actually falls outside of your estate. So importantly, you don't pay estate duty, or your estate doesn't pay estate duty on that. You don't have to pay executors any executors fees. The money kind of moves quite seamlessly from your name to your beneficiaries' names on your passing, and you just need to provide a bit of documentation. So it's quite a nice flexible vehicle. Biggest danger of a living annuity is that people start their retirement drawing too high a percentage. They draw 8 or 9 or 10% a year, and by the time they get to 67, 70, they've drawn too much. But in essence, that's a living annuity.
Thank you, Warren Ingram. Just a quick question. If you leave, if say you started off your retirement with 5 million in a living annuity and you depart this world and there's 1 million left, can your beneficiaries get access to the 1 million that's left, or do they have to draw it down, keep drawing it down as an annuity?
You get a few choices as the beneficiary. So you can do an accelerated payout where you take that 1 million, but it gets paid out to you over a shorter period than the 17.5%, for example. Or you can decide to take it on and actually make it a normal income generating investment where you pay it off, or you draw it out, I should say, let's say at the 2.5% for your lifetime. So the beneficiaries are given some choice. My recommendation is always to draw the smallest amount possible.
Warren Ingram from Galileo Capital, wrapping up this evening's edition of The Money Show. Thank you, Warren Ingram. Back again at 6 tomorrow. Good night.